Now, the Bank of Ghana is taking tough actions to rein in what it terms unregulated charges and practices in the banking sector. This bold push has compelled the central bank to roll out about 10 new industry directives set to take effect beginning this June. The move targets arbitrary fees, lending risk and governance lapses that the central bank warns could undermine financial sector stability. Governor Dr. Johnson Isiama has met with heads of all commercial banks to outline the reforms. Nilati has details from the opening of that crucial meeting.
The Governor, Dr. Johnson Isiama, issued a stern warning to commercial banks. He maintained that the era of unchecked and opaque banking charges is over and that the central bank will no longer tolerate exploitative practices that burden customers under the guise of operational costs. Among the raft of regulatory measures announced, banks are now mandated to review their pricing models. It comes on the heels of a ChannelOne business petition in which hundreds of public complaints on inter-account transfer fees were submitted to the central bank for redress. Effective immediately, all banks must now provide clear and upfront disclosure of issuer and transaction fees before processing, especially for forex, digital and card-based transactions.
We are also concerned about broader pricing practices that prevail in the sector. Indeed, we have received reports that some banks continue to apply interest charges on credit accounts that remain inactive. Even though they are inactive, some banks continue to apply interest charges, and this often results in cases where the accrued interest exceeds the original principal.
On the lending front, the central bank is introducing a 10% cap on non-performing loan ratios set to take effect in 2026. Also, all banks will now be required to publish details of blacklisted defaulters and chronic borrowers in their annual report to discourage irresponsible lending.
Banks will also be required to disclose blacklisted willful defaulters in their audited financial statements, along with sectoral breakdowns of NPL exposures. This added layer of transparency will sharpen both regulatory and investor focus on systemic credit risks.
In addition, there is a decision to enhance local governance, particularly in foreign-owned banks. Here's why.
This measure responds to a growing concern, and that is the outsourcing of major credit and risk decisions to offshore principals who are not subject to Ghana's regulatory oversight. These decisions are often passed down to Ghanaian boards for formal ratification, which often gives the appearance of local governance, when in fact, core decisions have already been made externally.
Specific guidelines on the new directives are expected to be out soon.
With this set of sweeping reforms basically to strengthen customer protection, both customers and the market will be monitoring closely how the implementation and enforcement procedures go. It will also be interesting to know what commercial banks make of these directives. We'll be finding out from them in the coming days. Reporting for ChannelOne Business, I'm Nilati.